Hello there, investorholics and friends. Welcome back to another ETF Spotlight review. Today we'll be taking a look at ILC, which is the iShares S&P ASX 200 ETF. This one will give investors access to domestic large cap and giant cap stocks. So when I say domestic, Australian market, so ASX. This ETF may likely be appropriate for investors seeking capital growth with a high to very high risk return profile. Is it that high risk? I don't know. I mean, you're looking at the top 20 companies here, so, hang around and find out, I suppose, won't you, eh? Hey there, investor. This is Scott. Crack the Sky Value Investing will be giving you up-to-date investing news and content so that you can navigate the markets wherever you are. My mission here at Crack the Sky is to give you the knowledge and the confidence to take control of your personal finances, expand your investment horizons, and crack your financial sky. So don't be afraid to give me a thumbs up. And also subscribe. It helps get the message out there. It helps pump the algorithm for YouTube. Just in general, it sort of gives me a bit more motivation as well to keep doing these little reviews for you guys. Thanks. Investment objective here. So the fund aims to provide investors with the performance of the S&P ASX 200 Accumulation Index before fees and expenses. The index is designed to measure the performance of the 20 largest Australian securities listed on the ASX. So the S&P ASX 20 is designed to measure actively traded and highly liquid securities that are among the 20 largest listed on the ASX. As always, we need to have a Y factor. Relatively low cost exposure to the 20 largest companies listed on the ASX. Focused exposure to Australian blue chips. Used to customize your domestic stock allocation and target large caps. So, I mean, if you're into that type of thing, hang around. We'll have a look at the breakdown of what I think about it in the coming minutes, I suppose. Okay, so let's have a quick look here. So we had a net asset value of $28.24. I was trading just below that at $28.19. So, if you're looking to buy ETFs whenever they're trading below the net asset values, are definitely a good time to have a look at them. You're getting them for cheap, or getting them cheaper, I should say. Market cap of 431 million. Not the largest ETF on the ASX, but not the smallest by far. So sort of mid-range size ETF. Management cost of 0.24%. For managing the top 20 companies, I think that they could sharpen their pencil and reduce their costs on it. I think it's probably a bit too high. Distribution, you get one quarterly, so January, April, July, October. Dividend yield, depending on the share price, fluctuates about sort of around to 2.5–3%. The 20 securities in the S&P ASX 20 Accumulation Index covers approximately half of the Australian equities market cap. So financial services account for about 43%. Resources and energy names also feature heavily, and they represent about 16% of the value of the index. So the thing to consider here is there are some sectors, or global sectors I should say, that actually aren't included in the index just because of the way, so the large Australian companies are all sort of banks and mining companies, so you're not going to get a lot of exposure to information technology. So that's something to keep in mind.
So earnings among the largest Australian firms are, predominantly home-based. So, you don't have any large international companies like Apple or Google or anything on our index. Mainly banks, supermarkets, and telecommunications companies. So, and they pretty much all generate their money here. So you're not getting any global diversification of income anyway by owning this one. It's all pretty much domestic. Investors should be aware that the fund is quite concentrated, sort of as we sort of said. There's only 20 companies in the portfolio. The top 10 holdings in the portfolio account for more than 3/4 of the total exposure. The index is dominated by financials and that kind of stuff, like I kind of already touched on. And you get obviously you get CSL, which is sort of the big healthcare company in Australia. Alternatives, have a look at SFY and E20. There's no really other that I could find anyway ETF that focuses just on the top 20 stocks in Australia. So this is pretty much very, very specific. So yeah, like I say, it's hard to actually find something that's similar to this. So those two options are a little bit different. But EX20 excludes the top 20 and only has the bottom 180 of the ASX 200, if that makes sense. So just something to keep in mind. And just depends on what your investment style is and what you think is going to be the best place to put your money for the long term, I suppose.
Okay, so let's have a quick look at some of the top companies here. So CBA, CSL, BHP, National Australia Bank, Westpac, ANZ, Macquarie, Wesfarmers, Woolworths, and Telstra. All the big guys. So looking at returns here, if you'd invested when the fund listed in end of 2020, you would have gained 134%. So it's not too bad. I mean, it's not the best, but it's not the worst. So since inception, the annual average return is 8.11%. So probably a little bit below what you'd be hoping for. But if you'd put your money into it 12 months ago, just post sort of the COVID crash, you would have picked up yourself a hefty chunk there, just under 33% return. The concentration of this ETF may result in higher volatility as the portfolio is more sensitive to business cycles. So got to also keep in mind regulatory actions in specific sectors. I think that banking is one that's kind of always sort of in the spotlight, so that's something to keep an eye on, and also other macroeconomic trends. Considering these aspects, the fund should form a portion of one's total portfolio in conjunction with other investments, such as mid-cap fund. So the fund should deliver solid value to investors and has the potential to deliver good long-term returns. The problem with this fund, I think, is if you are going to use it in conjunction with a mid-cap fund, why would you kind of bother? Why wouldn't you just bother buy an ASX 200 and ETF? So and then you're kind of getting the high end and the mid already all wrapped up. So for mine, if you're looking to diversify that far afield, then maybe you should just go and buy the other larger index ETFs, ones that cover the ASX 200 or 300 for that matter. Morningstar do have a good rating for this, so they give it a bronze, so that's effectively 3 stars out of 5. So I think it's something worth looking at, but if 20 companies isn't enough diversification for you, then maybe you should be looking for something that actually has more companies in the underlying index and therefore in the ETF.
Hope you guys enjoyed it. Thanks.
Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.